Corey Bayshore and Justin Dunwoody here again from Polaris Advisors. Today's topic, we're going to talk about the benefits of dollar cost averaging. I would say this is actually, not that any of the other topics aren't timely, but this is a very, very timely topic, given just the current state of affairs, as far as the economy is concerned, geopolitically, speaking, as well. As many of you may have noticed, for those that pay close attention, you've probably seen, the markets have been extremely volatile. You've probably seen, for those of you that track it closely, you've probably noticed, some ups and downs, with your 401k plan or any other investments that you may have. And I would tell you, from our end, I mean, this has kind of been a time-tested strategy that we've utilized a fair amount in periods and times when things are fairly uncertain, with regards to the economy and the markets and interest rates and you name it. So
the nice part is that a 401k plan actually kind of forces you to do this strategy. So you're kind of making one good decision by just participating in your 401k plan. Yeah,
and now that you mentioned that, Justin, I mean, even just thinking back, I mean, I can tell you, from the participants and folks that we interacted with, during, and I know we mentioned it, previous in one of the previous segments, the market pullback, due to the pandemic, market pullback over 30%. For those of you that were participating in the plan at that time, you were buying shares at a 30 or 33% discount.
Walmart special.
Yeah. So when the market fully recovered by July of that year, those monies that you were adding in March of 2020 actually increased in value when the market bounce back. So you increase by over 30% on those dollars. So that's just a example of the benefits of dollar cost averaging, and certainly, I mean, in the 401k, because it's salary deferral, you're putting in on a consistent basis. So you're like Justin mentioned, I mean, you are basically forced to embrace dollar cost averaging. But we've got just a few things to kind of show you why that's beneficial. So nobody likes to be forced to really kind of do anything, but it is a benefit of a retirement savings plan. So the first piece that we have is just an example, and many of you may not have the means to make a large lump sum contribution into an investment, and again, this is just a hypothetical example here of purchasing the index 500. So if you put a lump sum of 40,000 into that investment in January of 2008. So we're going back to the financial crisis in 2008. So very volatile market at that time.
Not the best time to make a lump sum investment.
Yeah, hindsight. When you got to the end of the year, you probably wish you hadn't. But you can see the price per share at that time was $133 a share. How many shares you purchased, and then what that value was come August of 2008. We're showing August of 2008 because if we would show November of 2008, it would really scare you because things really deteriorated after August. So they got much worse. And then you can see with the dollar cost averaging, just spreading that $5,000 a month, from January all the way through August, you'll notice how that price per share changed. So come August, it was all the way down to $116 a share. And you were able to buy, more shares that month than you were than any of the other months that you contributed that same $5,000. So when you look at where the value was in August of 2008, you're actually a little bit ahead, in this example. I would tell you if we continued it through March.
Still be down, but
yeah. But if you continued it through March of 2009, when the market actually bottomed out, you would have seen a significant benefit of having done that, especially when you take it out, over time, from that period going forward.
And your share price would have been, if you went out the whole way through March, you'd be kind of astounded at your share price.
Yep.
what you actually purchased those at, but then you go out 3, 4, 5 years when markets had rebounded and were significantly higher, you kind of see the benefit of how that dollar cost averaging helps you to buy at low points.
Yeah, and I mean the key with that, or the takeaway, is it just reduces the volatility. So when the markets are volatile, how do you reduce volatility without making maybe some mistakes with regards to changing your investment mix? Again, remove those emotions like we talked about in the prior segment, and this just helps you to ride out the volatility, because it reduces the volatility.
Yeah. And we're going to pull up another piece just to kind of expand upon that a little bit more. This is one of the cooler pieces that we have, that we show folks quite a bit. And it really does kind of go through that dollar cost averaging and trying to utilize that to purchase shares as inexpensively as possible. There's also a second component to it that I think is just really a cool piece that we show a lot of folks when they're in, especially 401k plans, because we get a lot of folks that are like, oh my gosh, markets are bad. Should I think about maybe pulling out of the market and go over here and put it in the fixed account or in bonds? And at the top of the page you're looking at, you'll actually see this isn't exactly about dollar cost averaging. We'll kind of hit this topic a little bit on this podcast as well, but just a really cool piece that in the last 20 years, 2002 through 2021, if you stayed just invested in the S&P 500 index fund, your 401k plan, you got your S&P 500 index fund. If you just stayed invested in that $100,000 in the K plan 20 years ago, what would it be now? $616,000, without adding a cent to it, which obviously you're not going to do that. You're going to add to it. But if you just missed the 5 best days in a 20-year period of time, you just missed those 5 best days, you're all the way down to $389. It's kind of crazy to think about 5 days in 20 years. If you missed the 25 best days on the far right side, I mean, you're talking about less than a month in a 20-year period of time, you're like a sixth of the value, 134,000. Yeah. So the really what this hits home is you trying to time the market and beat the market and make decisions and be kind of cute with your 401k. I'm going to get out of this. I'm going to get in this. It's really tough to do. Yep. It doesn't work. I mean, if you miss those good days, it's really problematic. The second half of that sheet is kind of back to our the topic at hand, which very similar to the one we just talked about, but it's kind of comparing a lump sum or a dollar cost average. And this one I think maybe a little bit more realistic. It's a $12,000 lump sum compared to $1,000 a month. So over the course of a year, something that's a little bit more realistic. But if you took that $12,000 lump sum and invested it on January 1st, and you get 480 shares because you bought it at $25 a share. If you actually just systematically invested that, and that's something we talk about a lot right now. Mm-hmm. Markets are really volatile right now. We get a lot of clients that come in and say, "Oh gosh, I have some cash in the savings account. I'm not earning anything on it. What do I do with that? Should I just invest it?" Well, things are super volatile right now. Should you go take $12,000 and just dump it in the market? Well, let's look at a strategy like dollar cost averaging. Let's take $1,000 a month and get it in over the next 12 months. So if Putin decides to blow something up next week and the markets crash, that's fine. We're going to put $1,000 in the next month and we're going to buy shares cheaper. And that's where you're seeing with that yellow graph. You're buying shares at $18, $16, $15 instead of everything bought at that $25. So by the time you get out through the end of the year, you were purchasing shares the whole time. You ended up with 617 shares instead of just buying them all at once. You ended up with 480. Yeah. So your average cost per share is less, which basically, just you're earning more in interest and paying less for the shares.
And over time, the value per share will continue to increase. Yeah. And that's a significantly more shares. Yeah. I mean, I would tell you, I mean, if there were two things, because people always ask you all the time, well, how do I become a millionaire? And it's not that you need to be, Elon Musk. You need to be, extremely intelligent and innovative. I would say it's, we talked about in the previous segment, it takes time. So the younger, the earlier you start, the better. And dollar cost averaging or just consistently investing over time. Because in this example, that Justin just shared, you see how many more shares you bought in just a 12-month period of time. Imagine doing that over 10 years, 20 years, 30 years. I mean, again, time, is certainly is something that is beneficial to accumulating wealth, but having or sticking to a consistent purchasing plan, and again, 401k plan kind of helps you do that. Is really how you're going to accumulate wealth.
And one thing we hit on too, we'll kind of close with it, is when things get volatile, we get a lot of folks that are like, oh my gosh, it's volatile, should I stop putting money in? Complete opposite. Yeah. When things get volatile, put as much as you can in. Yep. Volatility is your friend when you're in a dollar cost averaging or a 401k style program. Volatility is your friend. It's good, especially if you have significant years till retirement.
Completely.
So with that, we'll kind of end this episode and come back to you next time with another topic.
Thanks, everyone.